Happy Thursday. Happy Thursday. I told you I was going to be on this call. Didn't I tell you I was going to be on this call? But anyway, happy Thursday, everybody. Wow, I can't believe it's Thursday already. That this week has literally gone at like 500 miles an hour. So many amazing things going on. If you can mute, guys, if you are not muted, that would be great. So looking forward to the stuff today.
Okay, so this deal is
Right now.
uh-oh. Uh-oh, we got some technical issues back there. So this is Victor's deal. I'm just gonna walk him through and support him on the presentation here.
All right. This project or this business is related to car parts. It's torque converter manufacturing, automotive and transmission. It's been founded since 1970. The company has 23 employees located in Alabama. The CEO is willing to stay, so he's part of the team. He's going to be the partner for 19%. So he's staying, operating the whole entire business. I will be the one in charge, or the investor, the deal maker, and this will be my first deal. Next slide. The torque converter manufacturing, this deal has the value of the business is 5,050,000. It has 3 warehouses, 3 buildings, value at 1.950. The total value of the purchase price will be 7 million. The annual revenue is 3.3 as we speak, and the EBITDA is 1.2. I calculate this at the metric at 3.9 multiple EBITDA. Next slide. Any questions? We could leave for the last.
Good so
This
far.
project.
Great valuation so far. Keep going.
Thank you. The projects Perform Products Plus is 19% B2B and 10%, about 10% B2C. And what we do, we remanufacture torque converters for automatic transmission, and you could see the picture there. It's related. That's what we do. We order them. We get them from the landfills or the junkyards, if you know, and then we bring it to the house and we open them and we remanufacture everything on all the inside. We got it out and we put new parts. We use CNC machines to remanufacture all the components and part and make them durable. Next slide.
Oh, I love this business.
The transmission problems, the most common transmission problem is the transmission slip, transmission overheating, and the transmission contamination in oil and fluids within the transmission housing. And that's why the torque converters, they get blown up and damaged because of the friction. Next slide.
Awesome.
Our competitors companies are those are one of them. There's about 300 in the country here in the US.
Are these the top 5?
And the top 5, yeah, those are the top 5. The global torque converters market, if you see from 2021, global is been increasing at $5.5 billion. And the projection for 2021 and 2026, so we see that it's going to be keep increasing at 5% to 6% between the 2021 and 2026.
Next hey, Victor, just real quick as you go through this. So Ollie and myself used to own a business called Gear House, just like this in Baltimore. Very, very similar. I know a lot about this industry. I don't know if Ollie's on the call. I think he still might be a shareholder in it. I cashed out my equity about 6 months ago. So I'm no longer a partner in this deal.
Cool.
But yeah, but I know this industry really well.
There you go. See, Victor, I told you that's why you need to present it.
Go to the next slide.
Awesome. Awesome. Moving on.
Thank you, Mikey.
Moving on.
Moving on. Some of our customers, is we relate our projects and everything that we do is automotive aftermarket wholesalers, automotive aftermarket distributors, and retail car racing and restoration enthusiasts. So those are the numbers from 2023, just in average. That's so far that's what we got from all our clients.
Top 5
Some
clients,
of our
and we
clients,
can
we have
reference that
89
once we,
clients.
yeah, we
Yeah,
can
we go to
go
the
back to
agreement.
this once we look at the one sheet. Cool.
Go ahead. So
Don't mind me.
okay, the
I
financial
typed that up.
snapshot. Okay.
Go ahead, Vic. You got this.
That's a snapshot of the numbers from 2019 to 2022. That's the EBITDAs and all the increments. They have some issues between COVID, and they started ramping up after 2022. That's when they started implementing more sales and catching up new customers. Next slide. This is the projections for the future, and these are the numbers that I calculated.
Is this your
from the
growth? These are your
presentation.
growth. These are your growth projections, Victor. Correct? These aren't the sellers.
Yes. Yeah, it's in the one sheet as well.
Great. What drove the 53% year-to-year growth in this business, 22 to 23?
Because the increase of pricing, and what he did, he acquired a lot of inventory, so now he's selling it a little bit more expensive now, and he acquired more customers. And this the companies like Harley, Jex, Summit Racing, they buy more from him now.
Great. Okay. Yeah. There's a few little financial anomalies in that sheet. So the cost of sales, as you've added 53% to the growth, yet the cost of sales has gone down by 80%. Yet the overhead, the SG&A, has gone up like 3x. So it looks like they're putting cost in different places. But anyway, we can get to that a little bit later. Keep going.
Okay, next
slide. Okay.
All right. The Dealmaker, which is me, the purchase price is 7 million total. That's including the business, 5 million. The real estate at 1.9. So the seller is holding a 30% seller finance. He's rolling back 19%. And I'm getting an SBA through right now. We just talking to David to get this deal through, to close the deal. So I'm seeking for equity closing gap at 800,000.
So you're currently under LOI, correct?
Yes, indeed. Yeah.
Okay. Interesting deal structure.
Next.
I like it. Are you doing a 7A loan or a 504? Because there's a significant.
504 is including, because it's including the real estate, so it's going to be a 504, right?
Right.
7A and 504.
One quick idea for you to save you having to raise 800 and maybe a lot less is, do you actually want the real estate? Because if you don't,
not necessarily, but I could sell it.
I'm thinking if you don't, you could flip the real estate to an investor and pay them a rental income. So what that does is that's going to save you $1.95 million from the closing payment. If you can still seller finance the 1.9 and still have the rollover equity, then your SBA loan on this deal is going to be a lot lower. And then you'd probably get away with a 5%. So you might only need 150,000 to close this deal.
Yeah, according to the discussion that I have with David, Mark Antonio, he's working on the deal as we speak. And he said, let's keep the real estate involved, and we're gonna get you an extra cash.
I think that's bad advice, Victor.
Yeah.
I actually don't agree with that. I think for you to raise $800,000 of equity, you're gonna get diluted pretty heavily on the ownership structure, and and those investors are going to own, even if you have two, they're going to own more than 19% each. So they're going to be liable for the guarantee. So you're going to have to do the kind of the warrant and the PIP scenario as well.
Okay.
Personally, I wouldn't buy the real estate. I'd sell the real estate. So it's a $7 million deal, and we know
Right.
that we know that circa $3.3 million of the deal is not doesn't need financing because it's seller financing and it's rollover equity, right? So if you think about
Right.
a $7 million deal, right? You take out the real estate by selling it to somebody else.
Right.
So that's 7 million less 1950 is 5050 less the 3.3. So you only need $1.75 million in financing to close this deal, right?
Yeah.
You can use the rollover equity as the down payment potentially, right? So 1.75 million in financing, even if you did call it 2 million with working capital and fees and all those different things, you could probably get away with maximum $100,000 of equity on this deal. 100,000 versus 800,000. That means your dilution from that equity ownership is going to be way, way less. And it's going to mean a much simpler deal structure for you to close. In my professional opinion, I would not buy the real estate.
Yeah. Carl, would you also recommend or consider an option on the real estate? Because then you're renting it, but you've got an option to buy it in 3 to 5 years, which would add value to the business if you closed on that option, and you're paying it off over a period of time and building a deposit for it out of the profits, potentially.
If you can get the seller to keep the real estate, that's exactly what I would do. But if you sold the real estate to an investor, they might give you an option, Mark, but they would probably want a premium. So you could say to the investor, look, buy this from me for 1.95. I will give you, I'll sign a 10-year lease on market rent, or maybe even a premium to justify the purchase. But then I want an option to buy this within 5 years for 2.5.
Yeah. I wouldn't do it with an investor. I'd do it with the owner, make the owner the landlord, pay the owner the rent for the property. So he's still got an income from assuming the owner of the business is also the owner of the property. I'd do it with him too. So he's got an income from the property, but you've got an option to buy it off him at a prearranged formula or price because you put an investor in, it's a middleman. If you did an option agreement, I'm not saying you should, but it certainly does everything else that you're suggesting would be good for the deal in terms of lower payments, cash flow, everything else. The only other question on this, Carlo, is I noticed on the first slide that the EBITDA was 1.2, but in the one sheet, the EBITDAs look like 350 per year. Did I miss something?
Well, that was the projections. We can go to the one sheet projections.
Oh, okay.
Okay.
Yeah, go to the one sheet.
Because my question to you then, Carl, would be: is the business correctly valued on an EBITDA? If I'm right in what I thought I saw. Yeah,
because I thought. With the real estate and the 1.2 of EBITDA, then it's only a 4.2 times multiple, which is pretty low for this type of industry.
Yeah.
And Ankimatu was asking, where is it? It's in Alabama.
But I think the EBITDA is 350.
It's a Monster Show. Okay. Monster Show.
Oh, right, I'm mistaken. I misread the figures on the earlier slide. Please forgive me, guys.
Yeah, no, that's absolutely solid financial performance. So this is a world-class deal, guys. Like, this is an absolutely world-class deal. But I think there's a better way to do it, right? Like, you're not going to get $800,000 of equity for 18%. Like, I'm telling you right now, there's no way. Okay. Like, that's not going to happen, right? You'll be lucky if you get less than 40, right? So you're going to need 2 investors minimum to get them individually below the 19% cap. Like, I think you'll end up owning less than 50% of this business if you buy the real estate. I've done tons of these deals. Like, Mark Antonio is wrong. He's completely wrong, right? I would absolutely not be buying the real estate. I would figure out a different way to do it. And then you can buy this with maybe 10% dilution from an investor for only 100K. That's exactly how I would do it.
So I want to chime in really quick, right? Victor went to a few funding partners to help fund this, and a lot of them said no. DMA said yes. And I thought, Victor, let's get this on red light, green light,
Yeah.
right, instantly. So
Yeah, I think I'm not saying David's wrong. He's giving you a funding solution, right? Obviously, if you think about it, he's an SBA loan broker, so his fees go up the more financing you put into a deal. And I'm not saying that's why he's done it, right? But all I'm saying is, as a deal maker, my job is to get you the best deal for this. And in my opinion,
so in order for me to separate now that he's running the numbers and he's putting the whole deal together to present it to the bank or whoever the underwriters over there and the other side, can I separate that and find an investor that is willing to buy this building?
you can,
Or
right?
these
You
three
can.
buildings?
You can, right? So the two things I would do is, first and foremost, to Mark's point, go and talk to the seller and say, hey, would you entertain a deal where I just buy the business, you keep the real estate, and I have an option in the future to buy it from you, and you can negotiate what that price is. So to Mark's point, he's getting additional income per month. So it's like the classic retirement sale for him, right? He's getting a closing payment, plus he's getting monthly income, right? So, and he lives in Alabama, which is one of the cheapest places in the country to live. So that's,
and he's gonna stay in the business. He's gonna keep running the business for 5 years. So
yeah. So
until I
that's a
sell
great
it.
option. But I think for you, the best deal for you, Victor, is to not buy the real estate. That is
Okay.
my
That's fair enough.
massively strong opinion. I think doing a 504, even though you can 504, I think the blend on this David Giroll and Darren Yee would probably be around maybe 15 years. So the debt service would be solid, but you'll have to raise so much equity to make all that work. Then yeah, I literally I don't think raise it. I think raising 800K would be really tough. I think you'd have to give away maybe even half of the business. So I wouldn't do that. I think there's a much more elegant way to do it so that you can keep control and own more of that business.
But in summary, you love the business. It's making a great EBITDA. Got to
Yeah.
sort the property mess out to make this deal work. And I think I completely admit, I mean, you are a god as far as I'm concerned, Carl, you know that, but I think it's bang on the money. Do not buy the property. It'll kill you from a cash flow point of view.
love that.
Yeah, that's my opinion. I think it's an absolutely great deal. I think it was a solid presentation. So great business, great presentation. I just think it's the wrong deal structure. But that's easily fixed, right? It's not like Farley's deal, which apparently it's a $55,000 lawsuit, not a $55 million lawsuit. So maybe we got to revisit that next week. But yeah, I'm definitely of the opinion you should not be buying the real estate. All right, brilliant. We need to get some more analysis on this, guys. We're running out of time, and I have a massive hard stop in 26 minutes, and I know you guys don't like it when I'm not on this call, so I don't want to overrun. Let's go to David Giroll. David, what are your thoughts?
Yeah, I mean, I would want to run the numbers on the real estate, but I think I always look at deals with and without, and you know, as I think you've said before, I do the real estate when it enhances the deal and not when it doesn't. So, but my only caution or comment on that, if you're going to take the real estate out and flip it to somebody else, then you've got to adjust your EBITDA numbers and your projections to account for the fact that you'll be paying rent. So that can sometimes, you know, affect the analysis.
Yeah. But on 1.75 million, commercial real estate in Alabama is probably at a 5% yield. So you're probably looking at less than $100,000 a year. You won't have to pay property tax because you won't own the property. So $100,000 a year out of a 1.5 million current EBITDA is a drop in the ocean. It's nothing.
Yeah, right? I don't know. You'll probably be on a triple net lease on a commercial property, so you're going to be paying. You'll be carrying the insurance and the real estate taxes on top of the rental.
Okay.
But
all right.
but yeah, I would just run the numbers and see what makes sense. I mean, that's the numbers don't lie.
Okay, cool. Thank you for that.
Okay,
Real
awesome.
quick,
Thank you.
Jeremy Bronson.
Yeah, I think the one question, there are two questions I would have is, and I see it in the chat here that I made a note of, the customer concentration. I think 2 customers made up 2.5 million of the $3.3 million of revenue. I really want to dig into that and understand how sticky those relationships are, because that's a huge
Good
risk.
point.
And the SBA, I'm sure, would have an issue with that if they know that. So that's an issue. And then the one other thing to look at is inventory. I think was like $1.8 million, which is about 1 or 2 years of whatever your cost of sales are. So it looks like there's a ton of excess inventory in that business. So those would be my 2 things I would want to look at.
Yeah,
Okay.
and then I think just to round out some of the financial stuff, you definitely need to dig into the accounting in this business, because the cost of sales went way down and the operating expenses went way up. So it looks like they're putting costs in different places. The margins increased quite a lot as it went up 50% in revenue, which you would expect, right? Any business that goes for a 50% revenue growth year to year is going to have a big increase in margin, because a lot of the fixed overheads that are inside of the income statement are going to be leverageable. So that's the case. Darren Yee, just one opinion from you quickly on the switching out the real estate. Have you got an alternative view on that?
No, no alternative view on the real estate. I mean, you could try to just comp it, right? See if it's really worth the value. If it, is it higher or lower, right? I mean, if you get a deal on it, I would say like, Carl, buy it and then flip it to somebody else and put a triple net lease on it, right? But if it's not valued at where it's valued, then like, why buy it, right? So I would say, get an appraisal on it, or work with someone to do a commercial.
I did had an appraisal. That's the appraisal that I got from a different triple net lease buyer, that he was willing to purchase it with his group, and they needed to promote it, and they gave me this analysis. So 1.9 is the right evaluation for those 3 buildings. And with the SBA, the total monthly payment will be $63,000 a month. That's include for 25 years. So
Yeah. I real estate in Alabama is not going to massively appreciate in value. It's a big drag on the cash flow, in my opinion. You can scale the value in the business a lot easier than you can scale the value of the real estate. I would not be buying the real estate in this deal. If you've got somebody that will buy it from you and you can flip it, absolutely, that's exactly what I would do. It massively helps your cash flow. It's a low cost way of doing the deal. It drastically lowers your dilution, and it drastically lowers the amount of equity that you need to put into this deal, which will mean it'll be a lot faster for you to close it. So yeah, definitely check in on some of the numbers and what Jeremy said about the concentration. But all in all, really, really good deal. Let's go real quick to Al Greco, and then we'll move on to the third deal. Al, 2 minutes. What do you think?
Not even. I just want to make a quick point here, because I think it's pretty relevant. You disagreed with David's analysis or advice, and from a broker, in the mortgage brokerage business for years, his mindset is, okay, let me analyze this situation. How can I, and I hate to say it, it's how can I make the most money more often than not? So, take the advice with a grain, not necessarily with a grain of salt, but always look and analyze the other side of the deal. In this case, the other side of the deal is taking it without the real estate, which probably makes sense. The only thing I'm going to just also throw in, you have the advantage when you have the real estate. I believe with the SBA loan, you get a 30-year amortization, which could make a change in your numbers. So I would factor and look at that factor most prominently at first, and see if that changes your cash flow enough to warrant the acquisition of the real estate. Other than that, just be wary, because they're always looking to build that loan amount, because it's all about what they take home for the same amount of work.
Yeah, no, great point, Al. Yeah, on the 504 will give you 25 years on the real estate, 10-year on the business. So it'll probably blend. It's like a 2-to-1 ratio. It'll probably blend out around 14, 15 years. But you're right. The longer you can amortize the loan, the better. But I think my main concern is one, timing. To go raise that kind of money from an investor is going to take a ton of time, and I think he's going to end up owning less than half the company with all of the seller rollover as well, which I think he will personally end up having less of the deal. And the real estate's not going to double in value in the next 3 years, but the business might with all of the growth that he's putting in. So
I totally concur. Yeah.
So great deal to kind of debate as well.